Let's connect with Ajay Bhodke, Head Investment and Strategist and Advisory with Prabhudas Lilladher. Ajay, morning. Thank you for joining us. After a 5% run-up from the recent low, do you think markets are in for consolidation or correction?
I would say that the markets should correct, should sort of move sideways for some time, because we've seen a very strong rally of around 9% from mid of April till now. And I think the positives sort of in terms of sharp fall in crude oil prices alleviating the concerns of current account deficit, the market has sort of more or less discounted that. At the same time, I think we are in the midst of result seasons and we got to see how the result season pans out. I think till now 46 companies under our coverage have announced results, and although on the bottom line front there is a clear beat that the companies have shown. So vis-a-vis something like 12% growth in bottom line, those 46 companies have shown 17% growth in bottom line. But on the top line front, they've really caved in, and the top line growth has actually come in at nearly 50% lower, at around 5.3% vis-a-vis 10% that one has seen. So I think one will have to wait and see how the results pans out, and at the same time the political uncertainty continues to dog us, and we'll have to wait and see how sort of things move on that front.
Ajay, let's talk numbers here. Now, if I look at key numbers which came out yesterday, Union Bank and Punjab National Bank have come out with excellent set of numbers. Bond yields have corrected. The differential between PSU bank and private bank is an historic high. So is it safe to assume that in the near term we could be staring at a tactical move in some of the good quality PSU banks, at least the ones which have come out with good set of numbers?
I think I would still wait for a quarter or so, because you said that the two names that you mentioned have come out with numbers that have beaten analyst expectations. At the same time, let's not forget that banks like IOB or Dena Bank and a few other public sector banks have disappointed the street, and the numbers that were trotted out by them have been far below analyst expectations. And the main reason there has been not only has there been disappointment in NIMs, but also on the sort of the problem asset front. So I would be slightly worried even today of plunging headlong into public sector banks. I'll keep a close watch on them. I'll still sort of weigh in some of the private sector banks and NBFCs, which have trotted out excellent results. In fact, if you look at the numbers for the BFSI as a whole that have come in now, it's one sector that has beaten expectations of the market. And just sort of to give you some numbers, vis-a-vis 16% growth expected in top line, I think 24% growth has come in for BFSI companies till now, and vis-a-vis 15% bottom line growth, 25% growth has come. So I would still be market weight or slightly overweight on banking sector as a whole, banking and financial sector. But I will weigh my sort of bets with some of the private sector banks like ICICI Bank, Axis Bank, and in the smaller category companies like Jammu and Kashmir Bank.
Right. Just stay on, Ajay, for a second. Maruti CFO saying watching yen's trend very closely. They think that the yen should stabilize at these levels. However, in the interim, many believe that the yen could weaken further from here, as that's the intent really for the Japanese government, to weaken the yen, to boost exports and to bring about more foreign flows into the economy. The yen dollar is at 100, close to actually 101 out there. Ajay, come in on the view on autos right now, the cyclicals essentially, industrial stocks. What's the call there? I mean, do you think the recovery is perhaps in place there?
I think on the autos, we are basically recommending, continuing to recommend Maruti Suzuki with roughly 24-25% total import content, and the sharp more than 30% plunge that one has seen in yen. I think our auto analysts believed for the last couple of months that Maruti would be the biggest beneficiary of the same. At the same time, the company had a lot of labor troubles last year, in the middle of last year, and I think we clearly appear to be over the hump there. So I think also the petrol diesel differential has narrowed down significantly, and the large part of portfolio of Maruti being petrol focused. I think both on the fundamental side as well as on the currency side, I think there are tremendous tailwinds that the companies have. And hence I think 1860 is the price that we are looking at on a 1-year basis for Maruti. So we would sort of continue to look at Maruti as well as Tata Motors with an improvement in environment in the main markets for Tata Motors, namely United States as well as China, especially at the luxury end. I think that's one stock that we're looking at, and 340 rupees is the target price that we have for Tata Motors on a 1-year basis. So I would still be slightly worried about two-wheelers because the volume growth continues to be tepid out there. Competitive environment is extremely strong. Honda continues to gain market share at the cost of both the incumbents. So I would still advocate Maruti Suzuki and Tata Motors as the preferred plays in the auto sector.
Ajay, give us some money-making ideas.
I think I just mentioned to you the two strong ideas in the auto sector, Tata Motors and Maruti Suzuki. I think on the mid-cap side, I would urge you to look at Britannia Industries and United Phosphorus. So on the fundamental basis, I think our analysts believe that there is a lot of value in both the stocks, and one is looking at sort of 635 as the target price for Britannia Industries over a 2 or 3 quarter period, and around 185 rupees in case of United Phosphorus. The numbers that have come in case of UPhos also have been pretty strong. The major concern that investors had always was the working capital management and how to sort of crunch the working capital cycle, because the nature of the business is such that you tend to have higher debtor days. But the company has demonstrated over the year that they have been able to restrict the total working capital cycle, bring it down in fact by around 20-25 days from 104 or to around 89. Also the base business is started doing quite well, and hence we are expecting sort of a growth of around 14% in earnings for the current year, and with an ROEs of around 18%. The company is trading at at just 6 times 1-year forward earnings. So I think United Phosphorus and Britannia are two stocks that I would like to look at.
Ajay, I have a follow-up question for you. Why are markets suddenly revisiting agri as a theme? Rallis has been a marked outperformer. UPhos has been a marked outperformer. Jain Irrigation also has picked up with some steam. Any reason why markets are hot on agri?
I think the initial forecasts that have come from both the Indian Meteorological Department as well as some of the private agencies as well as some of the foreign agencies clearly are pointing towards near normal monsoons. Although one's got to wait till June and find out about the forecast on the spatial and temporal distribution. But the first forecasts clearly are quite encouraging, and a large number of these companies had suffered quite gravely last year because in the month of June we've had a sort of a complete we had very deficient rainfalls, although the rains did pick up in the subsequent half of the Kharif season. So I think in the build-up to the monsoons, the forecast of near normal monsoons, a large number of these companies are seeing renewed interest from investors.
Fair enough. What do you do with the commodity stocks right now? You know, the likes of Hindalco or Tata Steel on the index by itself, the cyclical names.
Yeah, I think our analyst, metals analyst, still continues to remain quite worried on the commodities, essentially the metal stock. He was moderately positive on among the resources stock Coal India. And sort of on domestic cyclicals, I think Shree Cement is a stock that he is consistently advocating now for last many months, and he's expecting a target price of around 5,150 rupees in the medium term in 2 to 3 quarters in Shree Cement, basically underpinned by around 19% growth in earnings in FY15, and the company has one of the highest, very strong ROEs in the sector, around 22% ROE it has. And trading at around 13 times 1-year forward earnings. The company is expecting to have extremely strong volume growth due to capacity expansions coming in over the next couple of years. And its markets of north are doing quite well. So I think Shree Cement is on the resources side a stock that we would look at getting in over the medium term.
Ajay, the real big howler yesterday was Jubilant FoodWorks. For 2 quarters on the trot now, the management of the company has indicated that they are experiencing slowdown. It's a very small business. They don't even clock a turnover of $1 billion on an annual basis. But on a small base also, the slowdown is very visible. How do you see Jubilant FoodWorks now moving in the near term? Because 2 years ago, everyone thought that Jubilant FoodWorks could go only one way, which is up.
Yeah, I think I won't be able to comment specifically on the stock because I don't readily sort of track the stock. However, I think picking up the thread from whatever you said, the consumption sector as a whole, there are concerns among section of the market that after the private domestic consumption, in fact, which has grown at a robust 8% from FY08 to FY12, the CSO estimates that this year in FY13 it has slowed down to nearly 4.5%. But on the ground, if you look at the numbers of the companies, it's quite a mixed bag, because you have companies like Hindustan Unilever or Dabur, which have shown very strong volume growth of 6% and 12% respectively. Whereas you have certain companies in the consumer durable sector where one is clearly seeing the slowdown manifesting in the volume numbers. So I think in the consumer sector, one will have to sort of really look at what subsectors within consumption are getting affected due to the slowdown, and what sectors sort of continue to chug along at a good volume growth clip to sort of look at tomorrow's winners among the consumption sector.
Where would you use the current strength to your advantage to take some chips off the table? Of late it's been a rising tide and just about everything has appreciated. Quality has gone up, but along with quality, some big stocks also have gone up.
I think I would continue sort of to wait now sort of on slightly defensive names, because as we discussed right at the beginning of the program, a very sharp 9% rally over the last 30 to 45 days. The fact that the market is today trading at 4.4% premium to 1 year forward earnings. I think the last 10 years Nifty's average is 13.5 times 1 year forward earnings. Today we are trading at 14.1 times May 14 earnings, or 14.4 times March 14 earnings. So we are clearly looking at, from 1 year perspective, a 4.4% premium at which we are trading. The second sort of valuation multiple I look at, Nikunj's MSCI India versus MSCI Japan, MSCI Asia ex Japan, and vis-a-vis 21% premium that on an average which we trade over last 10 years. Today we are at 27% premium. So the valuations clearly for the market as a whole warrant us to be slightly cautious, although I do take the point that the interest rates are on the downside, although RBI has clearly said that don't expect too much of aggressive cut in interest rates going forward. Inflation is trending down at the WPI level at least, and there is expectation that with the government's efforts to revive investments, I think the economy looks like bottoming out. However, I clearly feel it will be a U-shaped recovery, and with the sharp up move that one has seen, one needs to now continue to focus on fundamentally strong stocks with high ROEs, good earnings growth, and good cash hoard that they have. So one still needs to be slightly cautiously worried, especially because of the valuations have moved up very sharply.